Today we see the South African inflation rate data releases both year on year and month on month. I'm on the line with Cilliers of TreasuryOne to discuss his forecasts for the outcome of these data releases. Andre, welcome. Firstly, looking at currency, South Africa's rand weakened in morning trade yesterday as encouraging economic reports in the United States pushed the dollar higher. How do you foresee the rand performing in the near future in light of this? And do you see the currency struggling?
If I look at your question and I look at what happens in the markets and the trade figures and the economic reports over the United States that push the dollar higher, then I don't really see that the rand's really going to struggle. And if I look at the rand's performance over the last couple of weeks, then it's actually not nearly correct to speak about rand weakness or rand strength. It's purely pushed around by the dollar and what happens on the dollar markets. At this point in time, it's more of a question that the rand, if it weakens because of the dollar strength and the euro weakening, but it's actually gaining against the cross rates like the euro and the pound. So there's actually a bit of rand strength in this whole period. So no, I don't really see at all that the rand will battle or struggle during the strength of the dollar. I actually think that it will benefit the rand against the cross rates like the euro and the pound and the likes of that.
South African CPI data for July will be released today, with economists polled by Reuters predicting a slight decrease from 6.6% to 6.4% year on year. This is still outside the bank's target. What is your forecast for the outcome of today's data release?
And at this point in time, now that we're speaking, the CPI data has already been released, and it came out at 6.3%, which is 0.1% below the forecast told by Reuters. So outside the bank's target, as you mentioned, but with inflation sort of coming down a little bit and the increase in interest rates that we've seen last month by the Monetary Policy Committee meeting, at their next meeting in September, I do not think that there will be any change in interest rates, and I think they will keep interest rates stable and having another round of data before they make a decision on that.
And finally, ETM Analytics said in a morning note to clients yesterday that low interest rates have been ineffective in providing a positive boost to the economy. ETM suggested that rising living costs, which were not reflected in the official CPI numbers, were the cause of this. Do you agree with this or foresee another reason?
I think I disagree slightly with him. I think it's not just much the rising living costs. I think it's really more based on the heavily indebtedness of South African households, and that a major portion of the income is actually being spent on the repayment of debt. With rising interest rates, that puts further pressure on the income that can be used for spending, and I think that will continue in the months ahead. That the income will be under pressure from that side. So that keeps the economy at bay in the sense that if there's no spending from consumer side, there's no growth in retail sales, there's no growth in car sales or the likes of that. And that is going to be plaguing us for quite some time. I disagree slightly with them in the sense that it's rising living costs. I think it's more to do with the indebtedness of households.
Well, that's all we've time for. Thank you, Andre, for all your insights. Click back tomorrow when I'll be looking at the Eurozone manufacturing data. Goodbye for now.